Have you ever wondered why millionaires and billionaires essentially pay an effective tax rate of zero on their federal tax return? Because I swear to you, I figured it out. The reason it's because they're bald. It's the lacking of hair. I mean, if you look at Jeff Bezos, I'm totally joking. The bald I'm ultimately referring to is an acronym. B stands for businesses. A stands for assets, L stands for loans, and D stands for ultimately they end up passing away, they end up dying. My name is Carrington Dennis. I am a certified enrolled agent. Today, I'm going to be going over the acronym BALD and what it means to you and how you can save on taxes from it. See you there. Okay, so BALD, what exactly am I referring to? Let's start with B, right? Businesses. Why am I focusing on businesses? Businesses are absolutely necessary if you want to build generational wealth and if you want to offset taxes. Why? The IRS is a very strategic playbook. When you look through the IRS code and you're reading through it, you will start to understand that there are a ton of loopholes and a ton of deductions that business owners have the ability to ultimately receive. Why is that? The IRS wants to incentivize business owners. They want to incentivize people who are willing to take the risk of trying to start a business to, again, increase their overall personal income, have the ability to put others on payroll, and ultimately create jobs. Now, why is this so important? When you start a business, what does it ultimately do? And first, before I even answer that question, take 2 steps back. For this person who's watching this video right now, you as the individual, more than likely, because I know a lot of people ultimately make a W-2 income, you more than likely have a W-2. Now, I want you to ask yourself, what do you think is the highest W-2 that you can ultimately receive? Right? You can probably think of a number. Hey, you know what? If I stay in this career for the next 10, 20, 30 years, I can probably reach this amount of income. I can touch, 6 figures on my W-2. I maybe even be able to touch 7 figures depending on what industry I'm ultimately in. But you're thinking of a specific number, give or take, right? A rough estimate. The difference here, and really focus on this, hear what I'm saying. The difference is when you're a business owner, that number is not capped. So whatever number you just thought of, that number can be double, triple, quadruple. There is no cap when you are a business owner on the amount of income you can ultimately make. So this does 2 things. It helps you twofold. Number 1, when you become a business owner, a whole plethora of deductions open up to you. That the reason that is because the IRS incentivizes business owners who have the ability to create jobs for other individuals. Number 2, when you're a business owner, your income skyrockets, right? It's not going to happen the first year, not going to happen the second year. It could never happen. That's the risk of being a business owner. But if it does, your income significantly increases. Now you have all the liquidity in the world to go into acronym A. That is going to be assets. So once you're making all of this income, right, from your business, and when I refer to all this income, this could be $20,000, this could be $200,000, this could be $200 million, right? It all is in relation to whatever income you're ultimately making. But the second that, again, you open up that business, you start making money, whatever the case may be, we switch over to acquiring assets. Why are assets so important? Specifically, real estate. Like I said, the IRS incentivizes certain things. It incentivizes people who are looking to get into real estate. It does this through depreciation, 1031 exchanges, cost segregation studies. And if you're confused about what I'm ultimately referring to, just understand this one thing. When you're making a good amount of money, it is very good for you to allocate your income into assets that have the ability to benefit you threefold. And as of right now, I'm only aware of one asset that has the ability to do that. There might be a couple of other ones, but there's one main asset that has the ability to benefit you threefold, and that's real estate. The first aspect real estate has to benefit you is when you purchase that property. Real estate, typically, you're purchasing an appreciating asset. So number 1, it's appreciation. You're not purchasing a car that's immediately going to depreciate as soon as you drive it off the lot. When you purchase real estate, 9 times out of 10, I would say that real estate is ultimately appreciating. That's number one. Number two, that real estate has the ability to generate cash flow. You can have a long-term renter in there. You can have a short-term renter in there. Again, if the money coming in is more than the money going out on a monthly basis, guess what? Now you have a cash flowing asset. That's two things. Number three, last but not least, the depreciation and the tax benefits that come from real estate. When you purchase a property, you have the ability to utilize what is referred to as a cost segregation study to accelerate depreciation. And what that ultimately means is we're just creating a big paper loss on your tax return. A big paper loss that can offset the income that's coming in from the business that you started, or the W-2 income that you already had, or that side hustle you decided to partake in, right? So that's why acquiring assets is so important, especially real estate. Now, real estate is just one type of asset. You can also start to invest your money, right? So the second that you start making more money, you can start investing in the stock market, start investing in crypto. You can do all these different types of investments. And that leads me to category number three, or the L portion, which is loans, right? So now that you've acquired all these different assets, you have the business that's generating the income. With that income, you're purchasing these assets that are helping you offset the taxes. But now you might be thinking to yourself, and just stick with me here. If your business generated $100,000 and you went and took that full $100,000 and you spent it on acquiring stock, for example, or you spent it on real estate. Let's just say it's real estate. You spent that $100,000 on that property. Now what? I'm out of $100,000, or I have that $100,000 invested in the stock market. I don't have $100,000 sitting in my bank account anymore. What can I ultimately do? That is when loans come into play. And this is the real kicker. Billionaires, millionaires, they understand how to utilize loans. Because what is not taxable? A loan. A loan is not taxable to you. So you're telling me I can go acquire assets that are going to help me offset my taxes, such as real estate, or such as I can go purchase stock, for example, right? SpaceX is going to do an IPO soon. I can go purchase a ton of stock and then take loans against it. I can take a loan against my real estate. That's often referred to, if you have a primary home, that's often referred to as a HELOC. You can do a cash out refinance, right? So if there's appreciation in the home, or you purchased a home, you did a couple of repairs, now it's being appraised at a higher price. You can refinance and pull your money back out, right? Or if you have stock, for example, you can do a stock-based loan or a stock-backed loan, and pull and get resources that way. On top of that, last but not least, if you have a insurance policy, right? A life insurance policy, for example, especially if it's a whole life policy, typically you have the ability to invest those funds into a stock market, whatever the case may be, and take loans against whatever is invested in your cash value whole life policy plan. So this is a very, very big benefit that you receive once you start acquiring assets. You have the ability to take loans against those assets. When you take those loans against those assets, now that is more liquidity that you can reallocate to more assets, continue to try to build cash flow, push money back into your business to try to increase the business income, right? Or you can put that money in your pocket and have that as a safety net, a rainy day fund, whatever the case may be. Last but not least, we've acquired all these assets. We started this business. Business is generating a good amount of income, right? We've taken all these loans against our property, whatever the case may be. What happens next? Ideally, we ultimately pass away. And why do I say that, right? If I started to acquire stock at a young age, let's just say I started at the age of 30. I started to acquire stock, and this was from my normal W-2 income. And then I decided to start a side hustle at 35. And I really struck it big once I got to the age of 40, and it's generating an extra $100,000 worth of income on my side hustle on top of my W-2 income. That's great. When I started acquiring those assets, I started acquiring the real estate, I started acquiring the stock. All of that is highly appreciated. I never told you once about selling the real estate, selling the stock or anything like that, right? So that's all significantly appreciated by this time. If we're 30, 40, 50 years down the line now, all that's significantly appreciated. If we decide to sell it, we're going to have to pay a ton of capital gains tax to get out of that. That's why we decided to do those loans. But push come to shove, now I'm at the ripe age of 99 years old, let's just say, right? And it's about that time for me to ultimately pass. Do I sell all of my assets now? Absolutely not. Because my loved ones, right? My sons, my daughters, my grandchildren, for example, they need to be able to acquire my assets and not be hit with such a substantial tax from them acquiring my assets. And how do they do that? I pass away with those assets in my name. What is that going to do? That is going to grant those grandchildren, your children, whatever the case may be, a step up in basis to the fair market value at the time of death. Meaning, if I purchased $100,000 worth of stock back in 2000 and I was on my deathbed today, and that stock is now worth $1 million, if I decided to sell it, my kids or me, for example, would have to pay tax on $900,000 worth of capital gains. With me passing away, my kids get that stock. That stock gets a step up in basis to the fair market value of today, meaning it's as if those children or my grandchildren purchase that stock at $1 million, so they can sell that stock at $1 million and not worry about any type of taxable gain, because it's as if they purchased it at $1 million. That is how the rich is ultimately continuing to get richer. That's how they're continuing to acquire assets to offset any income that they're ultimately making. And they have everything and their assets and their children and their wills structured so tight that in the event that they ultimately pass away, it is going to be a ton of actual tax benefit that's coming to, again, their children, their grandchildren, whoever else is ultimately stated in that trust or that will. If you got any value out of this video at all, if you have a different perspective, you think I got something wrong, let me know in the comments. If you got major value, feel free to drop a like, feel free to subscribe. Again, my name is Carrington Dennis. I am a certified enrolled agent. I drop videos like this every single week, just trying to give you guys a little bit of knowledge as to how the rich are ultimately getting richer, how to save on taxes, and making sure that you are going to be financially well off in your future. Thank you so much for watching. Catch you in the next video. Bye for now.